Welcome back to another episode of me sticking my nose into the charts every single day until I discover a trade model that makes me millions and millions of dollars. So initially, I thought I found my model. Okay, I outlined it, drew a little picture. The very next day, I literally saw it play out on price action. I executed it, and boom, played out just like that. And after that, I was thinking, this is easy. I got this figured out. All right, let's just go back in tomorrow and do the same thing, and then do the same thing, and that's it. Boom. Man, I'm going to start making money soon. Not the case, folks. Not the case. All right. So I'd like to argue that the worst thing you could do for yourself is get it correct right off the bat. Because what does that do? That sets the bar high, it sets a standard. And then you think, oh man, this is going to be easy. I got this in the bag. Then your ego gets involved. It starts inflating your ego. Then you don't want to be wrong. And then when you do get it wrong, you feel like everything's going to shit, everything's falling apart. But it's not. You're just a beginner and you're learning. So I'm going through all of that right now. See, I made a filter for when I started demo trading. And you can see that the first trade that I took, I got correct. Everything after that, wrong. But I've learned so much in this entire process. Literally, I've been able to refine my rules, refine my trade model. See, I have this paper journal right here. It is called a Remarkable. It's pretty cool. It's in a little folio. Open this thing up. It's got a little pin and everything. So I'm just doing all sorts of journaling in this thing because, as you can tell, I have learned a lot. Because let me program with this. Let me program y'all with this information real quick. Again, for like the 20th time. When you get it wrong, you have to appreciate the value that that loss brings. It reveals so much insight about yourself and the market. And I say this in every single one of my videos because when I understood this, I reached a whole new level of maturity in my trading and I was able to handle losses so much better. Like I am on a 11 trade losing streak, right? But I'm not bothered at all because I'm learning and I've done so much journaling in the Remarkable in my paper tablet. I've been able to just continuously refine my rules, refine my trade model. Okay. So each time I mess up, I'm getting better. And I mean, eventually I'm going to get to the point where it's just like boom, boom, boom. I'm cranking out profitable trades left and right. And it's going to be effortless because I know exactly what I'm doing. But the only way I can know exactly what I'm doing is if I just get it wrong so many times that I know exactly what not to do. And that's how it works. And that's how this game works, right? So we have to be really, really exceptionally good at handling our losses because if we aren't, you're not going to make it in this game. Let's be real. You're going to let it get to you and you're going to give up. So that is something that you have to conquer. You have to get over the fact that you are going to get it wrong over and over and over and over again, and you are going to fall on your face. You have to get over that emotional barrier and appreciate the value that your losses bring. So I've just been studying continuously over and over and over again. But anyways, with that out of the way, not that. We are already on it. Let's get into today's session. Now, obviously, I got it wrong today. Let's see. So I took one trade before the 9:30 open at specifically 8:06 in the morning during the macro, and I took a second trade at 9:45. So let's start on the daily time frame. I'm gonna try to keep this one rather short, but here we go. So coming into today, my bias is bullish. Why is my bias bullish? Because we have Thursday's range. See this large up close candle. Now on Friday, the following range, we have a TGIF, which is simply a 20 to 30% retracement back into the weekly range. Once we have a directional move on that weekly candle, right? So if we go to last week's candle, we can see that we have a directional move. On Friday, we see a retracement back into the range, and that denies this large candle of an imbalance. So what is that? That's an immediate rebalance. We trade right back down to this candle's high. And this would be a fair value gap, right? Because usually when we have a large range candle, it leaves a fair value gap. But we trade down to this candle's low, denies it of an imbalance, and that's an immediate rebalance. Now, in the following candles, I can use this discount wick to gauge the strength of the market. And you can see that we failed to trade down to the consequent encroachment or the midpoint of this wick. And what does that indicate? Strength. Because we treat wicks as inefficiencies. We treat them as if they were a fair value gap. So if we can't trade down to the consequent encroachment of a fair value gap, what does that indicate? Strength. So in the following two candles, what do we see? Fails to trade down to the midpoint. We have this large up close candle, not necessarily large, but it's an up close range, right? And this high form relatively equal highs. So in yesterday's session, now my objective for this week was this buy side liquidity pool here, right? We have relative equal highs if we look at the previous week high, which is Thursday. So this was the previous week high right here. Relatively equal, right? So this range, yesterday's range, Tuesday, runs the previous week high, but it leaves this high intact. So today, I am expecting the market to accelerate up into this pool of buy side liquidity, and it does so. So that's my bias on the daily time frame. I came in today thinking higher prices, and post 9:30, I didn't trade with that bias, and that was a mistake that I made, which I'll cover. So in today's price action, my 7 o'clock to 8 o'clock model is actually present. Let's review that real quick. So I have time-based models. This is what I built through simply watching price action. Literally, I didn't have to take any trades to build these trade models. But basically what I'm looking for is simply a range, right? Or the start of a market maker buy model, a consolidation range, a perfect box of price action. And then I want to see price initially drop down lower, run the relative equal lows, run sell side liquidity first, because then it'll defer to the other side of the marketplace and reach for that buy side liquidity. I want to see it drop down into a higher time frame point of interest. This could be a 15-minute, 1 hour, 4 hour, daily, or weekly pool of liquidity or PD array. And then I want to look for simply a market structure shift, a change in the state of delivery, a breaker formation, and then just read the order flow and allow it to tell me that, yes, this thing is bullish and we're reaching for that buy side liquidity that we left intact when we dropped lower initially. And then I'm reaching for my clear draw on liquidity on the higher time frame, which in today's session was that large pool of buy side liquidity on the daily time frame. If I go back up right there, so dropping back down to the 15, we see exactly that. Notice we have this range right here, this perfect consolidation range, right? And what do? Initially, we drop lower. We run the sell side liquidity below this low and this low. They're relatively equal. And we drop down into a higher time frame point of interest, which is what I outlined in the model. It's the daily order block. So if I go back up to the daily time frame, that's the open price of this down close candle. This is a bullish order block. So extend the open price of that out in time. And look how we just hammer it. Literally perfectly. That is exactly what you want to see, right? Original consolidation, drop down, takes the sell side first, hammers the daily order block, and then boom, we have large displacement off of that. So when price reaches a PD array, we want to demand displacement off of it. And here we see clear displacement, right? Then we have a change in the state of delivery. Here we have a 15-minute order block, right? Look how price respects the open price of that, wicks down into it. And this would be a propulsion block, right? Because we have a down close candle into the down close candle. So we have a bullish order block off of a bullish order block. And look at the reaction right here, right? Propulsion block propels price higher. So I have clear intel overnight in the London session that this thing is reaching for the buy side liquidity above. Because initially, I'll run through it again. We drop down, take the sell side first. We reach into a higher time frame point of interest, which is that daily order block. Also, a new day opening gap. We demand displacement. We get displacement. We have a change in the state delivery. This is a bullish order block. Extend that open price out in time. Come trade back down into it. Respect it on multiple tests. Propulsion block. Displacement. This is now a bullish order block. Close over the open price of this down close candle. Trade back into it. More displacement. And this leaves an imbalance. And I framed the trade idea off of this imbalance. So there are so many pieces of information coming together telling me that this thing is bullish and it is reaching for the buy side liquidity above these highs, right? And if we look at the previous day high, they're also smooth and they're relatively equal to, you can't see it on this time frame, but it's relatively equal to this high, right? Because we come up near this high, but we turn away, engineering more buy side liquidity. These are very clean. These are exceptionally clean. And it's obviously drawing towards this pool of buy side liquidity as well as the previous day high, because if we zoom out, we get a look at the range, we can see that price is in much closer proximity to the previous day high than the previous day low, right? At this point in time, this is where I frame my first trade setup. Look how close we are to the previous day high in difference to the previous day low, right? So obviously we're reaching for that previous day high. It's unreasonable to expect the markets to trade all the way back down here and reach for the previous day low, especially after we see this reaction off of that bullish order block on the daily time frame. It's just not reasonable. So here's where I get my first trade idea. And I was actually correct. My draw on liquidity was correct because it was my 7 o'clock to 8 o'clock model. Everything was present. It was perfect. But I simply got stopped out because it traded down into a deeper discount than I anticipated. So let's go over that. Let me delete all this. Let me put the executions on the chart. I need to connect to my broker. It's paper trading, not a broker. There we go. Perfect. So look how the bodies of these candles are reacting to that 15-minute buy side imbalance, sell side inefficiency. So not only do we see a close above it on the 15-minute time frame, but we also see it on the 1-minute time frame, right? So this drop down initially works the lower quadrant of the 15-minute buy side imbalance, sell side inefficiency. Now, once it works the lower quadrant and leaves it, we don't want to see it come back down to the lower quadrant. Once it leaves it, we don't want to see this revisited ever again. We want to see consequent encroachment act like a brick water price, support it. Don't want to see it trade back down here. And this is exactly the reaction we want to get. You see how it trades down into the upper quadrant and then boom. So notice how the bodies of the candles close above that 15-minute imbalance, and that is exactly what I want to see. So for me to frame a reversal, I want to read the bodies of the candles on the 15-minute time frame around a higher time frame PD array, such as 15, 1 hour, 4 hour, daily, weekly, to grade the strength and weakness of the market. Now, when I see this, right, on 2 consecutive candles, then that gives me a valid indication in the marketplace to look for a long, because that indicates strength. So drop down to the 1-minute time frame. Even the bodies on the 1 minute are respecting that 15-minute imbalance. So this is the perfect reaction. Look at this. We even have a breaker. We have a high, low, a low, a high, a lower low, and a higher high, right? So we demand displacement off of these P arrays, and boom, we get it. And this is also during the macro. So the macro is literally tipping its hand to you, right? We annotate the macro right here. This is 750 to 810 macro. Now on the macro, boom, immediately starts spooling for buy side liquidity. So that is the algorithm literally telling you, hey, I want to run for buy side liquidity. Now it comes just shy of those highs on the 15-minute time frame and then turns away. What is that doing? It is priming that high. That is simply engineering more buy side liquidity. So notice how we come just shy of the high, turn away, and then boom, we run right for it, right? So this is literally just priming the high. So now where I got long was a return back down into this imbalance right here. Now I view this as a good place to look to get the market long. It was below equilibrium, right? I was buying on a downtick into this fair value gap. But the problem was that we had this imbalance right here. So this is an imbalance right here. Let me fix these settings. Don't extend it right. Make it gray. There we go. Right, so we react off of the imbalance, but look what we have approaching this buy side imbalance, sell side inefficiency. We have a sell side imbalance, buy side inefficiency. And look how we trade up into the midpoint of it. And then boom, we lay a large down close candle across the midpoint of this fair value gap, which is not what I want to see. That is not the reaction that I want to see. So boom, we lay a large downrange candle across the midpoint like that. And then this also leaves a fair value gap. So I'm gonna delete this so you can see it. And then we see institutional order flow entry drill on that candle on this imbalance right here. And then rolls over, stops me out. So I have my stop loss below candle 2 low right here. Stopped out. Now this was just trading down into a deeper discount, running for this inversion fair value gap as well as the bullish breaker. Notice how the bodies of the candles close inside of the bullish breaker. And if we draw the consequent, not the consequent encroachment, this is an order block. So we draw the mean threshold on the order block and boom, there we go. Perfect reaction off of that. So I don't view this as me doing anything wrong. I had the draw right. I knew where the market was going. It just traded down into a deeper discount than I anticipated and it stopped me out, which is fine. That's cool. I'm not hurt by it. I'm not bothered. I'm not upset because I know there's going to be plenty of other opportunities present. Now, how I felt after this loss was it was good because it showed me that I've matured so much in my trading journey. When I used to have scenarios like this in the past when I was trading supply and demand back in my days, when I'd barely get stopped out and then see the market run right in my favor after and hit my target, dude, I would lose my shit. Like it was crazy. Just crazy emotional reactions. I'd probably stand up, start kicking shit, throwing my chair around, just really just pounding my fist on something. But now I'm just like, it's fine. It's totally fine. Like I'm just content with it. Like I'm just at peace. And that's the whole point of demo trading is to literally desensitize yourself to the outcome. It's to get in there, push buttons, feel how it feels, know how you react in certain situations. And right now, I'm reacting very well to all of these situations. So I'm very proud of myself for that. So obviously, I'm lacking a bit in the technicals and knowing what I have to look for and actually executing these trade ideas because I went from simply recording my observations and price. I wasn't taking any trades to actually pushing the button. And that's just something that I have to get used to. I have a lot of new elements incorporated into my trading, like actually getting an entry, managing stop losses, managing targets. All of that is entirely new to me trading ICT. And this is only my second week doing it. And so obviously I'm going to get it wrong in the beginning. And I'm just getting used to getting stopped out over and over and over and over again. And now it's at the point where it doesn't even bother me, which is exactly how you want to feel when you stop out because you appreciate the value that your losses bring. There you go. That is the right mentality that you need. And you need to start with demo trading because you need to know what it feels like to get stopped out. You need to know what it feels like to get it wrong. You need to know what it feels like to get barely stopped out and then see the market run right in your favor after. You have to know these things. You have to know how you react in these situations. Record them, journal them. Like after this situation, I was so emotionally content with what just happened. I had no reaction whatsoever. I was like, oh, okay, cool. I'm not bothered by it. I'm not hurt. I don't care. I'm not upset. And what did I do? I journaled it in the paper tablet. So you got to know how you react in these situations. And sure, my technicals are lacking, but the psychology aspect is really, really improving. Like my mental game is getting really, really strong because I mean, I'm just getting stopped out over and over and over again. And I'm so used to the losses. So there's a positive and a negative to everything, right? I'm getting it all wrong right now. I have 11 incorrect trades in a row. But guess what? My psychology is improving. I'm able to handle these losses very, very well. So it's all about perspective. There's a positive and a negative to every situation. It doesn't matter what it is. It doesn't matter how bad you may think it is. Some good can be taken out of it. You may see taking 11 losing trades in a row as completely negative. There's nothing good you can get out of that. I see it as look how I'm handling these losses. Look how I'm being desensitized to outcome. So for everything, there is a positive and negative. It doesn't matter what it is. It does not matter what it is. There is a positive and a negative to everything. And if you only focus on the positive, then you can only see the positive and you only get the positive. So there you go. That's that trade. Now, obviously, it reached my draw on liquidity, right? And I was on side. And this move, see, if I got long here, I was on side all the way up until it reached my daily objective on the daily time frame. Now, here's where I messed up. So I think a problem with me is I am a bit impulsive. And here I kind of just jumped in on the first presented for value gap. And I've done this in the past too, when there's not a clear setup. So going to 9:30, I was studying this perfect box of price action. And I wanted to see what side of the marketplace do they take first, because usually it'll defer to the other side, right? Usually if we run for the buy side liquidity first, then we'll reach for the sell side liquidity second, which is what happens in this case. We do come back down and take these relative equal lows underneath that perfect little box of price action, right? So this is a market maker sell model, but it doesn't happen when I anticipated it to. It happens once we deliver to the daily objective. that buy side liquidity pool on the daily time frame. Now here, and this is not good. This is an indication that I have some work to do. I need to control my impulses because I literally told myself this thing ran right out the gate at 9:30. I told myself I'm not going to short the first high that gets put in because that is a trap. And I know that from past experience from just watching price action. But what did I do? I got short off of the first high that got put in. So we come up, close below Thursday daily high, roll over. We inverse the first presented for value gap, trade through it. We come just shy of these lows. And so now I'm thinking we're going to trade back up into it and then roll over and come clean these lows, right? So this is just me staring at the 1 minute time frame. I'm not considering the 15 minute. Well, actually I was. The 15 minute, we had this imbalance right here. And so I drew this out in time. And as soon as I saw this candle still close inside of that imbalance, but the wick reaches up and runs these stops, I viewed that as a sign of weakness somehow, some way. So I knew where the market was going. It was reaching for the previous day high and that objective on the daily time frame. But I was fading that, which is a problem, another problem that I have to get over. So the move at 9:30 is not always going to be a Judas swing. In this case, it reaches right for that objective on the daily time frame. You just have to know where the market is at relative to that higher time frame. Like, what are we doing on that higher time frame? Which is why it is so important to adhere to the higher time frame, because that literally tells you what the market is reaching for. You have to study that and know what is this thing reaching for, and you don't want to fade that until it gets there. So a huge lesson that I learned today is about market maker models. So we can see that this is a market maker buy model, right? We have consolidation here, consolidation here, consolidation here, and we just keep dropping down deeper and deeper into a discount until we reach that order block on the daily time frame, and we leave smooth highs above every perfect little box of consolidation. So once we see a smart money reversal, look how this thing aggressively starts a buy program. Now you know it's in a buy program because look how it just continuously puts in higher highs and higher lows. So at the moment, price is not interested in sell side liquidity because it is delivering to an objective. And we are not going to see a reversal until it delivers to that objective. You have to wait until the price run reaches its terminus, which is a higher time frame point of interest. Then you can look to fade the market. See, I was looking to fade the market here when it had not reached its terminus. So I was essentially standing in the way of this market maker buy model, and I got ran over because of it. So you have to be aware of what is this thing reaching for on the higher time frame. See, are we in a market maker buy model? We're in a market maker sell model. What is it reaching for? Has it reached it yet? Because I don't want to fade the move until it reaches its terminus. So until it delivers it to the objective, then I don't want to look to fade it because you'll get ran over, right? So it's clearly in a buy program, continuously putting in higher highs and higher lows. And then boom, 9:30 is not a Judas swing. We open, we run right out the gate towards that buy side liquidity pool on the daily time frame. So 9:30 is not always a Judas because in this case, it's really reaching for something, and it does so. So you don't want to fade the move until it gets there. And let's go back down to the 1 minute. Let's go to the trade log. So that's it. It's Wednesday. We still have 2 more days this week to get better. I don't care if I keep losing. If I win, cool. This is the beginning. I'm demo trading. I'm supposed to get it wrong. It's going to be like this. And I understand that. So it doesn't bother me. All right. See ya.